Hello, everyone. We are here for a special meeting with Tom Basso. Those of you that have been watching CB3 Live know that I've interviewed Tom 3 times in the past. This will be our 4th interview. I caught up with Tom after he traveled to Singapore and spoke to traders there and learned about the culture of trading in Asia. So that was fascinating. And then we talk about creating and maintaining a trading plan. Tom Basso brings 50 years of trading experience to the table. And it's something that I can't possibly offer you. So it's my honor to interview Tom whenever I can. And here it is, our 4th interview, Tom Basso, Market Wizard, aka Mr. Serenity. We hope you enjoy it. Tom, welcome back to CB3 Live. I think it's been almost a year since we've been with each other talking about the markets. How have you been?
I've been great. It's been a wonderful year. I've had a good time, done a lot of great things, and had a lot of great experiences, and still doing a lot of the same things I do in trading every day, and making new friends around the world.
Yeah, so speaking around the world, we're just going to cover a couple topics on this video because you have so many interviews. I have to be razor sharp in what I talk about. So I want to talk about your recent Singapore trip, and then I want to talk about a trader's trading plan, how to utilize that, how to keep it updated, and then preparing yourself for certain market conditions, some of which have happened since our last interview. So why don't you tell us about Singapore? So tell us about the trip, and then I'll ask you some questions about it. So you made a trip over there and spoke to a bunch of traders.
Yeah, the trip was a cruise that my wife hatched a plan, and we started in the Seychelles, which is off the east coast of Africa. Went to the Maldives, where my wife actually broke her ankle on a snorkeling ship, a little boat. She didn't see a little recessed area where they store the ropes, and everything was painted light blue, and it just didn't have any, with the sun being what it is, there was no shadows. It was very hard to see.
Oh, no.
So she went down, and the rest of the trip we took it easier on her. We didn't do any marathons or anything. There was a wheelchair by the time we got to Singapore, but we went by way of the Maldives, which was phenomenal snorkeling. Then we, ducked around India to, next up would have been Sri Lanka.
Did she snorkel with you? I'm just curious.
Oh, yeah.
Okay.
Oh, she snorkeled after breaking her ankle.
That's amazing. Truthfully amazing. So, well, keep going. That's great.
Yeah, it's hard to stop her. I have to work hard to keep up. Then we went to Indonesia. Penang is the name of the sort of resort city. And then we went around Malaysia and Indonesia to Kuala Lumpur. And then down through the, straits, I'm not sure what they call them, into Singapore. Singapore, to me, was the most interesting destination on the trip for a variety of reasons, and part of which involves trading, because I ended up with a talk at the Singapore Exchange where I was interviewed by a couple of locals, traders from I think it was either certified or charter market technicians associations or something like that.
So when you say local traders, were they actually market makers? They're not still trading on the floor, are they?
No, these are mostly individual traders, but all part of a society that shares ideas and has get-togethers and talks trading, talks charts.
Okay.
Do a lot of indicators and chart patterns and whatever they want to talk about, I guess. And so I think the experience we had in Singapore was interesting because in one way, I'm a big fan of freedom and allowing people to make up their own minds on a lot of things. I'm for free press. You're not going to hurt my feelings if you call me a name or anything. I got over that when I was bullied as an elementary school student. So not a big deal to me. But what I think happens in Singapore is sort of interesting just as an outside observer. You show up highly, highly stringent on getting in there. Lots of checks on the passports and entry electronics to make sure that you are who you are supposed to be and that you're supposed to be there at that time off of this ship. And when are you going to leave? You don't get to stick around. And the sign that's most profound is at customs. It says, it is illegal to bring chewing gum into Singapore. And that's because they don't want it anywhere. People stick it on the bottom of benches or just toss it or spit it out. This city is one of the cleanest places anywhere. And
refreshing, I bet, after most American cities.
Yeah, it really is. And so it's interesting. My wife asked some of the traders at the get-together that we did about crime, because she and I both noticed it felt extremely safe there. Everything, it was as safe as being at Disney World or something. It just seemed like really everything was very orderly, and the people were happy, and the people just treated us like royalty. It was just great. And one of the traders said, Mrs. Basso, you could go out by yourself at 2 a.m. in the morning, by yourself, walk down a city street, and you would be totally safe. Now, the reason is they're very big on if you're caught doing something as a crime, particularly, for example, just if you rob somebody with a gun, you are automatically hanged. So they don't have a whole lot of robberies.
Well, that's a deterrent now, isn't it?
So, they're very stringent, but there's a lot of people. It's landlocked, so they have to build up. So a lot of high rises. Individual homes are very difficult and expensive to pull off because they just don't have the real estate. They either got to go down or they got to go up. And the only other way they can go out is to reclaim land from the ocean. So they bring in barges of granite and whatever and dump it in the ocean and eventually build up small islands where they let it settle for about 20 years. And then they can build another high rise.
Which is what the South Pacific looks like. A lot of those islands.
And so they're like into 100-year planning, which is so interesting also because, a lot of countries are not even 100 years old. In fact, Singapore is not 100 years old. But you end up with a lot of thinking through issues and problems of having a lot of people close by. Like, for instance, simple thing, if you have a skyscraper, you've now gotten rid of potential for people to have their own yard and have maybe a little garden or trees. So they plan intentionally parks nearby a lot of these high rises so that people can empty out of the building and go across the street and have a picnic or be out in the yard or be out in the grass. And then what they do is whenever they have common areas, unlike the U.S., it's a pet peeve of mine. Here we are in Scottsdale, 330 days of sunshine a year. And I look at some of the landscaping in the common areas along the sides of the street, and there's trash thrown out of the cars. Nobody's maintaining anything. There's weeds coming in from the desert that are
sounds like Chicago,
naturally invasive, and nobody bothers trying to get rid of them or anything. And my own yard is very beautifully manicured. Everything looks really nice, but it kind of ends once you go off my property. And so I look around, I'm driving around, and I can't help but mutter comments about, oh, look at that. Isn't that ridiculous? Why'd they plant that there? Why'd they do this? And in the case of Singapore, you have the National Forest Service, I think it's called, or something to that effect. And it's crews of people from Monday through Friday that just go along all the common areas along the streets and not only pick up anything, if anything was there, which the Singapore people just don't litter like that, But they also do a great job of pruning. There's flowers everywhere. The trees look perfect. It's really like you're in Disney World or something. You have this just very idyllic little place. It is hot. It can get rainy. We were there during monsoon, so it rained quite a bit. But that's what umbrellas are built for. And temperature was very moderate. Had some great food there. If you love any kind of Asian food, there's everything you can imagine.
Oh, I bet. And a very different culture from America. So I would presume that would mean that the traders bring a different mindset in. And I know that you spoke in front of 175 or 670.
Yeah, there was supposedly 180 capacity in the SGX Singapore Exchange's auditorium, which is a beautiful place, by the way. If you ever watch CNBC and they're broadcasting from Singapore, we were, 20 feet from their broadcasting studio. And cool. We had a stage, great sound booth, spotlights, anything you needed up there. They had quite the facility. And they had about 5 seats open on a Monday night.
How about that? Well, you were a big draw, obviously. So what are they trading, Tom? And is it more futures or more equities or local equities or?
Bank stocks are the big thing there. And I think, I'm just having a guess, but it might be something relating to Hong Kong going to the Communist Chinese and some of the banking. Because back in the day when I worked with a lot of banks, I was an FX trader, biggest part of my business. And I spent, I guess 3 trips maybe going to Hong Kong and visiting clients there and going to conferences there and stuff. And never went to Singapore. This is my first trip to Singapore ever. And I think what's happened since the communist takeover, some of those operations in Hong Kong, various companies have sort of fled. And one of the most logical nearby big cities where you can put up a skyscraper and call it your new headquarters would be Singapore. So Singapore is really enjoying a lot of stuff coming out of Hong Kong. And it is a bustling place.
It's sort of the equivalent between a Florida versus a California, or a Florida and a Texas, or the exodus from what we call in this country blue states to red states. Mm-hmm. In Asia would be from a communist nation to a free nation.
Correct.
Wow.
And so Singapore's economy looks like it's going crazy. The building is nonstop everywhere they can. The parks, we saw the botanical gardens there and the gardens at the harbor, I think they call it, or gardens at the bay, I think is the name. One of the most magnificent indoor gardens I have ever seen. And second, maybe it's a toss-up to me in my mind, Bouchard Gardens in Vancouver, which is over in Victoria off the coast from Vancouver, Canada, has always been in my mind the number one garden I've ever seen in my life. It is pretty impressive. If you've never been there, you got to go if you like landscaping and flowers and how you put it all together to make it beautiful. In the case of Garden at the Bay, I think you're running if not a close second, you're certainly number one in terms of the best indoor garden I've ever seen.
Yeah. And how many acres inside? I mean, it must be huge.
Gosh, there was a 2-story waterfall in there.
Wow.
I mean, you're talking a big place.
Wow. So how do they handle the time difference? Obviously, when we trade, you and I are looking at this. Well, maybe you're not looking at the screen, but I'm looking at the screen at 5 p.m. on Sunday. That would be 4 p.m. your time, just to see where things are opening up. But they have just the opposite issue. They can be trading late into Friday night, so their weekend may not start till Saturday afternoon, because they're trading literally into early Saturday a.m. if the markets are busy here. How does that affect them?
There's been interviews that I've done with traders that are still up at 10 and 11 o'clock at night. But in this case, the Monday that I did this panel at the SGX, it was Martin Luther King Day and it was Inauguration Day in the U.S.
Oh,
So the U.S. markets were completely closed, so there was no conflict there. But if you're
hmm.
trading bank stocks in Singapore on the Singapore Exchange, you're talking about Far Eastern banks,
Right.
and their stocks are trading in normal Singapore hours.
Yeah, this is not Citibank and Goldman, and there's not as many people trading J.P. Morgan and Citibank over there. They're trading their own
Right.
local bank stocks.
Correct.
Okay.
And I don't know if that's ever going to expand into more industrial issues across the Far East, to get away from some of the bank stocks. But it seems like there's a very large affection bank stocks in Singapore.
You'd think they'd be trading AI or quantum computing or some other things like that, but no, really focused on banking.
Bank stocks, and I also think a lot of them, one of the differences I noted between, say, US traders and Singapore traders, Asian traders in general, is a tendency to not to push the envelope a little bit more on their position sizing. If they have position sizing, it's definitely more aggressive. They want to, have the big winner. They're very entranced by return and a little bit not thinking too much or thinking through a long-term plan towards losses. And,
Really?
borderline gambling type of feel to it
Sounds like
in
their
that.
concept of a drawdown is different than ours.
Yeah, they're very pragmatic. Okay, so I blew up. I'll just try it again. A year from now, I'll save up some money and do this again. There's not quite the long term plan. Maybe it's because their country is so young and their lives have to change, and so they kind of roll with it and they take their shot. And if the shot doesn't work, they just start over again, and keep going. It's this very stoic
Is that
kind
age
of.
specific though, Tom? I mean, because you're saying a 28-year-old trader might have that mindset, but a 62-year-old trader could also have the same mindset? That
I had lunch with one.
really,
Yeah,
and
he
just
had blown up or had really hurt himself twice, and he was trying to get advice from me on how he should approach the third time.
so you and I might look at 1.5 or 1/2 to 3/4 of 1% on a full size position, 2%, 2.5%, nothing to them at all, or am I just inferring
Well, or
incorrectly?
maybe at least one or higher.
Yeah.
Uh, trying to they're trying to nail down a 40-50% return if they can, a little bit more. I mean, I'm not saying they're all crazy, but and there's some that are almost very conservative, but there's quite a lot of them that are very
Hmm.
into a little bit more of the flash, a little bit more of the racy track record, or the hope that they could pull that off.
Maybe more
But I don't
Rolexes than we have
appreciate,
here.
yeah, I don't think they appreciate what it takes to be able to do that in any kind of consistent, successful fashion.
They're battling probably, I would guess, liquidity different than what we have. We have the most liquid markets in the world. I've grown up with them. I've become accustomed to them. I would think if you go to any other country, even the DAX or the Life, really liquid European markets, Singapore, though, probably not the same liquidity. Does that affect slippage, with the bid ask? Does that affect their methodology at all?
Well, I think one of there's no short selling concept. So it's buy it long and either hold it or I don't know how much they trade it. I suspect there's a great deal of bear market risk in there, but they haven't seen one for a while. The economy's going great, so everybody gets used to having a bull market that seems to never end. So it's unclear. You'd have to go through another 20, 30 years and a couple of bear markets to figure out a little bit more about what their real true mentality is. But I gather that things have been good there lately, and they're very into making the big number if they can.
So are you saying that the exchange doesn't allow short selling, or they don't have an uptick rule? Because that's obviously a very different trading
I don't
culture.
know, but the subject never even came up. So I
Really?
pretty much assume everybody was trying to go long and trade long bank stocks. I really don't know. I don't trade bank stocks in Singapore, so I couldn't tell you, and
Yeah,
I
I
didn't
don't
look it
either.
up. Yeah.
All right. Anything else you want to tell the viewers about the trip? I mean, this is great. It's great to hear these cultural
Well,
differences. And
yeah, the time zone is weird. I'll give you that.
yeah,
Everything's flip flop. It's like everything I would do normally in the morning, you have to do before you go to bed, and everything I do in the afternoon, I would do in the morning. So it's everything's flip flop upside down. So you get used to it. You'd have to just schedule your day around it a little bit different. And like you said, sometimes like Friday might be actually Friday. It'd be the opposite. They actually close down early. So when we hit our Friday afternoon, they're into their Saturday morning already.
right. I guess what I said earlier was presuming that they're trading the S&P futures because those are the most liquid futures on the planet. If they want to trade the S&P, they're going to give up part of their Saturday morning to do it, right? Because
Uh,
we're still open, and they're
well, yeah, but we're closing down on Friday afternoon, so it's probably already made its move for the week or whatever,
yeah,
and New York traders are going home,
sure,
so Singapore would be pretty much on a Saturday morning. I don't think there'd be a whole lot of action
right.
unless you were just trying to catch the last 15 minutes before the close or something like that.
Right. And there are rare days, I guess, when the ending of the Friday session really has any importance. Sometimes it does, but it's rare, obviously. But if they're trying to trade U.S.'s non-farm payrolls or CPI, it's a very different time of day, obviously, than it is for us. So,
Yeah, the difference would be for our schedule to theirs is as we get into the aftermarket trading or the pre-market trading, I guess, if you will, on Sunday afternoon into the evening in the U.S., they're at Monday morning already.
right. Yeah, exactly. So, well, why
So
don't we move to trading plans? So, my hope in this section is I've read both your books. I've read your position sizing 3 times. I've read All Weather Trader 1.5, not quite through the second time because I went back to position trading because of an experience that I had. And I'm betting that our viewers, some of them that are traders, have had these similar experiences, and I really want to give you an opportunity to speak to them, especially in view of the last section of this little interview is going to be talking about Monday, February 3rd, which we both know was a really violent outside day. But before we get to that, trading plans. You were thoroughly, I won't say exhaustively because it sounds pejorative, but it was thoroughly covered in All Weather Trader. I have mine. I'm still refining it because it takes time. How many
yeah,
traders do you know that have a trading plan that actually use it? And what would be your recommendation to give someone an idea to start to take it out of their head and put it on paper?
the first thing you need to do is to start with one basic concept, whatever it is. Whether it be, I'm going to put together a conservative list of dividend paying stocks and trade them to the upside and hold them over the long run and try to go for long-term gains on these things or something. You have to have some objective, some base core philosophy that fits you and that you can execute every day or week or whatever period that you operate in. And I think too many people try to I've had this happen a lot. People are just virtually trying to copy what I talk about in the book. This is what I came up with to solve my own situation, not solve everybody in the world's situation, because everybody's different. And I think I tried to say that in the book, but I think some people just kind of, yeah, whatever. And then they try to copy me.
And probably because, and I'll speak for, because I have far less experience than you do, people, especially Americans, want a quick panacea. can I just read these 12 pages and just do this and it's going to work? And the answer is no. You have to find out what fits like a glove. And you say that, you do vigorously state that in your book. So that was crystal clear. Don't doubt that for a second. But do people just blow it off and say, no, I'm just going to do it anyway, or do they really make it their own? You'll know if you can write down and fully explain your trading plan, in my opinion.
Yeah, the thing that's key to all of this is once you come up with a strategy, then you need, say, a buy-sell engine. You need a way of triggering your buy. So if you're going to buy a dividend stock, do you screen it on dividend yields? Do you screen it on liquidity issues? Do you screen it on volatility? Lower is better or higher is better? You got to make a lot of decisions. But once you settle out with, okay, here's the way I'm going to approach this one part of my portfolio, the strategy, and it's going to start this whole process. You have to understand every single indicator you're using, understand the math, understand when it's going to tend to make money, understand when it's going to tend to lose money. When is it just going to be just treading water and not doing anything, and you're likely to get bored. But you have to do this ahead of time and understand your strategy intimately. Then you can sit back and say, all right, now that I know, here's the types of markets that I'm going to see, chances are, good results. Here's the types of markets I'm going to struggle. You can look at when those markets have existed historically. You can try to see if you can come up with indicators to give you an indication that you're in that type of a market, or that the trend has shifted against your main strategy, and try to develop a second strategy perhaps that has something to do with exploiting this tough period with the first strategy, and hopefully creating some profits to offset the losses in the first strategy. So now you've got a couple strategies, and they're making money and losing money at different time periods, hopefully all having a positive expectancy to produce profits over the long run, but making those profits at different time periods. So it stabilizes that overall equity curve and gives you a lot of psychological comfort.
Psychological comfort, that's the point.
Fall down on not understanding the indicators and what those indicators are there for and how to use them, and where are the Achilles heels of these indicators in the math that's used. They just say, okay, Tom uses a Keltner channel, so I'm just going to use a Keltner channel. So you go over to your trading platform and they got Keltner channel, so let's put the Keltner channel up there. Yeah, 2.0 times ATR over the last 21 days. Sounds good to me. And that's about all the thought they give it. They don't understand what an ATR is. They don't understand what the 2.0 is. They haven't really considered a whole lot, and they haven't really thought through how is that going to affect their ability or lack of ability to be able to execute flawlessly this strategy using this indicator. And that's where things fall down, because you get into a tough period with every strategy. You're going to have drawdowns. I'm in a drawdown right now, still am, coming out of it nicely, but it'll take a while. And, you really, if you mathematically think about it, traders are in drawdowns the vast majority of your life. You very rarely are making new highs on a daily basis. If you have new high, new high, new high, you have one down day, you're in a drawdown.
Exactly.
It's a one-day drawdown.
The point you make is so
coming
huge.
Up where you're going to be in a drawdown. So you're in a drawdown most of your life. And you just got to understand what that is and how what you're doing is going to climb yourself out of it. And I just think a lot of people abandon good strategies and don't really develop good multi-strategy approaches just because they just don't understand what they're doing, and they're just trying to copy something. And, I had just a guy, I think it was an Asian actually, here in the last couple of days, sent me something about, I understand that you've shifted a lot of stuff over to futures. Why did you do that? And I said, well, I'm in the U.S. and the futures have a little easier tax treatment than if I were to buy and sell ETFs all the time. So there's no wash sale rules. There's plenty of liquidity. I can go long and short. I can go short without borrowing shares, which is an advantage. And margin is treated differently, so I can more efficiently work the capital. So there's just some advantages there. So again, I'm designing what I do for me, not for anybody else. I would not do what I'm doing right now and try to do it for clients, like I would have done in Trendstat days.
Yeah.
This is just for me.
Well, the 60/40 tax treatment is pretty important too, right? Especially if you have a large account, which we have here. And I don't know if they do in the European countries or in Asia, but it is true here. So that would, again, slant your bias towards using futures over equities. So.
Right. And then the second corollary question is, why don't you use FX? And I said, well, FX is all short-term capital gains.
Yeah.
And futures is not. FX doesn't have an exchange behind it. So I've got to worry about the credit worthiness of the bank or the institution that I'm doing the FX trade with, right, to make sure that they can come through and make good on my profits. If I make a profit and they take a loss, I got to make sure they have enough capital to pay me my profit. If they declare bankruptcy, then I'd make a bunch of money that never shows up. If the exchange is behind the futures contract and I'm trading the same currency but doing it by way of the futures, I've got an exchange backing it. And so that's reassuring.
I have a feeling that some listeners might be thinking, well, if that's the case with your FX trading, then it would make more sense, it seems, as I'm listening, to trade Bitcoin and Ether futures rather than raw Bitcoin. And of course, there's thousands of coins available. And we know that those exchanges have had theft issues. They've broken in and shut down. You know, the super big ones like Kraken and Gemini have not had too many problems. But I don't think anybody's shut down the CME or shut down the CBOT or
not
the CBO. Yeah. So that's one reason there. On the trading plan, I think that if you're not an experienced trader, it would be helpful to literally create one, refine it, keep it on your desk for these three reasons. And what do you think about this? Inspiration, peace of mind, and accountability. You have decided when the markets are closed, and you should not write a trading plan when you're middle of a trade on a Tuesday and non-farm payrolls coming out in 3 days. It should be done on a weekend. But to use that as your, lowercase b Bible for how you're going to make your decisions, you predetermine your attitude as a trader based on your trading plan. What do you think about that strategy?
Yeah, I think that's a good. All three of those are excellent. It's sort of like I don't know. You know where you want to go, so you get yourself a map or a GPS system, Google Maps or something, and you plot out how you're going to try to get there. And you get your various tools like a car that you're going to drive, or the GPS that's going to tell you when to take a turn left up ahead, and then you execute. And well, lo and behold, you maybe end up at your destination eventually. If you start trading and you're just making it up on the fly, I don't know where you're going to end up, and you don't either. And so I like a trading plan just to try to distill a lot of potentially complex topics down into something that you can easily execute either daily, weekly, hourly, whatever time period you're trading in. And I think so many starting out traders, the novice traders, they think they're just going to watch a chart and, oh, that looks like it's bottoming out now, I'm going to go in and buy it.
Yeah, you have no chance, which is why I suggested keeping it on your desk. I want to go back to something that you said, because I think we really need to, even if we just say it again, and I'm going to say it again.
Okay.
You will spend most of your trading life in a drawdown. Mm-hmm. Deal with it. Is that too harsh? If you have 5 up days in a row, that's phenomenal. 5 new account highs in a row. How many times does that happen? Maybe once a year? And the rest of the time, you're in a drawdown and you need to emotionally prepare for that. I'm going to get to a little bit more on drawdowns as I move forward in here. I want to share with traders and how important it is. I'm going to go back to your first book, okay, the position sizing. I had read it only once, and this was in August of 2024, and Jay Powell made a remark, and the VIX futures were on fire, and I woke up on August 16th with a, for me, huge $35,000 open position profit in all sides of the market, short the S&P, long the VIX, etc. And I froze. I had not read the next section we're going to talk about, which is protecting open position profits, not by scaling out, but by recalculating your risk. And so I gave back a lot of that because I was saying to myself, I don't want to go against my system. I don't want to go against my system. It hasn't hit my stop loss, hasn't hit my stop loss. And I see you smiling because I think you had a similar experience in a market called silver.
Yeah, sure did.
For those that haven't read the book, could you, in person, now I don't know that you've shared this on other interviews, tell us about that. And of course, this was like 4 decades ago, but it's a fascinating story.
A long time ago. And this was back where I think my account was somewhere in the, I want to say it was 130,000 or something. I was trading futures and, I was using the reasonably sized silver contract even. And I was trading multiple contracts, so I had a pretty good position for 130,000. It was probably more leverage than I would ever think about trading today. But nonetheless, followed my strategy. I'm a good trend follower. I'm going to nail this trade. Got it. Got in. It turns out it was sort of the Hunt's trying to corner the silver market, purportedly.
Exactly. Yeah.
And so up goes silver, and it's pretty much starting to go limit up. And I'm just, man, this is very volatile, and my account is swinging like crazy. And I'm looking at my account, and it's basically silver and a bunch of other things that don't count. Yeah. If silver's up that day and I'm long, I'm making all my money on silver. The rest of it is in the decimal point. And
sure.
And if I have a down day on silver, same thing.
Exactly.
My account's down big, and the rest of it doesn't make a difference. So I hung on and dealt with the stress of all of that. That was pretty close to not sleeping at night, type stress, wondering how things are going to be the next day. And back in the day, because of lack of automation, calling your broker about once an hour, what's silver doing? And when it was all over, the silver trade had gone all the way up to about $500,000 was my account. So I started at 130. I ended up at the peak somewhere in the close to or right at about $500,000, which is a pretty nice return off of a $130,000 account. And then it started going back the other way because the exchange said, wait a second, we're getting suspicious. There's a little attempt at cornering going on. We're just going to raise the margins to 100%. Well, whoever it was, the Hunts, couldn't come up with all that margin money, so they would have to sell. So now it was limit down, and my 500,000 ended up at about like 250,000 by the end of the trade. Which, to the astute observer of my story would say, well, that's not bad. You went from 130 to 250. That's a pretty darn good return. And in my mind, I'm saying, yeah, but I was at $500,000.
Exactly. That's what I felt like in August.
At that point.
I had all that.
How you look at it, and as a money manager, I have to say, people that hire you think the way that I was talking about, $500,000 down to $250,000. They're going to paint you with pretty much in the industry of having a 50% drawdown if you go through that. So being a professional money manager later and trying to deal with just my own psychology, I started realizing that just because I properly put the trade on, caught the trade, enjoyed the run and all that, doesn't mean that I shouldn't strive to keep my portfolio as a portfolio all the time. Why do I want one thing out of 10 things driving all the returns up and down, and the other 9 things don't count. I want them to be a little bit more diplomatic or democratic with the risk and the return. So I had already at that point adopted an initial risk and volatility level control scheme, thanks to Larry Height in the first Market Wizards, gave me the inspiration. I give him full credit. He talked about making your bet size the same. Bets in a casino would be how much you're willing to lose. So that, to me, mathematically translated to, here's where I'm getting in, here's where my stop is, that's what I would lose. That's my bet. If I make all the bet sizes the same, I've got to do something like percentages, because if I don't do percentages of my equity, then all the bet sizes are going to come out different. Like if I do it dollar-wise or anything else, it's going to come out weird all the time.
Has to be percent, yeah.
Has to be percent. So I guess, engineering background that I have and math, I just saw the formula when I'm reading the chapter. And so I put it right into place. And within a few weeks, I did some studies and, hey, this is a great idea. It smooths out the equity curve. But then by correlation to that, when I went through that silver trade, I started thinking, maybe I can apply this concept to the existing positions as well, not just the initial position, because things change. And then I started thinking through, what does a typical trade look like? Well, in the silver trade, and everybody's been in, hopefully, on a trade like this, where you get in perfectly, thing starts taking off, and it's like an F-35 with the afterburners on. It's going vertical.
Parabolic.
Recently, it's things like coffee and orange juice has gone through that. Cocoa's had some runs. Even the stock market on certain 5-10 day periods have had some pretty big runs.
Certainly a long VIX can do that too, right?
Yeah.
A long VIX can absolutely go parabolic, which happened to me in August.
So here is your stop. You've got an indicator set. You've successfully triggered, say, a buy to the upside. So it's gone through your indicator. It's now breaking out to the upside. You are long. You've sized your positions beautifully. Everything's cool. Now what happens is this happens to be one of a few markets each year that goes vertical. And so good for you. Now you got to deal with an existing position that is running so fast that your poor indicators can't keep up. They're down here someplace, and you're moving your stop up fast and furiously every day, as much as you can justify with your indicators, but your risk is getting wider and wider and wider.
Exactly. And then your psyche is getting...
Sooner or later, it's going to top out and come back to your stop loss, and that is going to be a drawdown. And so I started thinking about that, and I started thinking about how does that balance out? If we modeled 1 out of 10 positions in a vertical market like that, and the other 9 aren't doing appreciably anything, what does that do to the portfolio, and how can I kind of balance this out better? And it became pretty simple. I just said, as a market increases and is creating profits, I'm willing to sort of play with some of those profits. I'm willing to take on extra risk. So if I had, say, 0.5% in the initial position, maybe I allow it 1% in an existing position. So I'm giving it room to make money, move my stops as much as I can, but as the risk gets greater, I'm willing to say to myself, look, as it gets over 1%, I don't care. I just don't really want more than 1% in my position. Or maybe it's 2, or maybe it's 1.25.
Sure.
Different for everybody.
Well, and in your book, you tested that.
But point is, now you have a way of capping and saying, hey, I've got 10 gold contracts here and gold's going nuts. The math would say I only need 9 now, so sell 1 off. Pretty easy.
Yeah. I'm going to read from your book, because for those of you that are new to this, what we've just talked about and Tom has told you may seem like, can I figure that out? Let me read from the book, and I would urge you to go to this position sizing book, chapter 9, and read it 5 times. Most important chapter to me in the book. This is from Tom in the book. At some point, as the risk goes from, say, 1 to 1.5 to 2.5 to 4 to 6, the ability of your portfolio and your psyche to take the hit of the market moving straight back to your stop loss comes into play. Depending on your buy-sell engine, you simply may not be able to move up your stop order as fast as the market is moving, which is just what you said. So how do you handle that? Therefore, we need to set our ongoing position risk allocation percentage at a higher level than our initial allocation percent, but limit it to a sensible level of the portfolio's risk. Anytime a position takes so much bigger, it just gets fatter and fatter and fatter. You see pictures of Texas on a map, and the Texans' view is that Texas is this big and the rest of the country is this big, right? But when a portfolio has a position like gold or the VIX or a short S&P, or do you remember cocoa from last year? You just can't let it continue there. So this is continuing in the book. For example, we might start with 1% of equity risk allocation percent to calculate our initial position, and then let that position grow to 2.5, at which point we continuously peel off 2.5, a position to get to 2.5, and just keep it at 2.5 risk. You might be peeling a position off every few minutes if it's something like the VIX. I mean, this happened to me in December, where I was long 20 and I went to 19, 18, 17, like 8, 7, 10 minutes apart, because I used that principle. Thank you, right there.
Well, if your strategy was to do it intraday, some people would peel it off at the end of the day. Some people peel it off market on open the next day. Whatever your strategy. If you're weekly, you'd peel it off once a week. You don't need to. If you're looking at it once a week, then you're not going to peel it off, like 5 minutes at a time. You're just going to go wait until you do your thing.
A market like the VIX, though, that if you're looking on a weekly signal and this blow up were to say happen in your favor on a Tuesday, all of that could be, the VIX could be back down at 18 by the end of the week, right? So this is really important, because now I'm learning, as well as everybody else is learning, even if you're trading on a weekly signal, you'd never change that to just say at any point in time, even though I'm on a weekly signal, if this gets to 4.5%, 5% of my portfolio, you wouldn't trim back, or would you?
It's up to you. It's your strategy. But if I'm going daily, I'm going to do everything daily. I may be out playing golf or
sure
taking my wife to lunch or something. I'm not looking at a screen, so I wouldn't even know that the VIX was doing this or that. I'd wait till the end of the day. I'd get my data and say, oh, the VIX was really crazy today. On the opening tomorrow, I'm going to peel off, or sometimes in the aftermarkets, if there is an aftermarket on something like a euro or a British pound or whatever, there's pretty liquid aftermarkets or pre-markets for the next day, and I'll just peel off a couple of contracts there. And, the theory, there's a debate on this that goes on forever. If you are volatility adjusting or risk adjusting your ongoing position, you are probably over time giving up some of your potential to produce the extremely large returns. So
Sure.
If you're trying to get to the 60 to 100% level on your returns, trying to run a sensible portfolio and volatility adjusting your existing positions and all that stuff probably is going to limit you from getting there. But the other side is it's going to reduce your drawdowns. So it's going to make your psyche a whole lot easier to deal with, keep you in the game a lot longer, reduce your risk of ruin, which is an important thing to think about. And that just fits me. I mean, again, this is a lot of what I write about is just the things I've discovered to help myself here.
Sure.
And I think it helps a lot of other people from what I hear, in the feedback on social media. And
I'm positive. Positive.
But there's some people that would argue with me, no, I'm not going to do that because it's going to hurt my returns and I want to make 100% or whatever.
Well, your all-weather strategy, this applies to that, because we know, I mean, I have a program that I offer to our clients that doesn't have any stop losses, and it's got a 370% return over 7 years, the length of the time I've been doing it. But there have been gruesome drawdowns, and I have to limit any one client to 12% in that, all right? Because I'm not going to have an SEC complaint because they had 40% of their net worth in that. So it is true. It is true that if you don't use stop losses, you have the potential for greater returns. But what price, peace of mind, and lifestyle?
Exactly.
That's why you have the moniker Mr. Serenity. And the strategy you just discussed that I implemented in December enabled me to sleep much better that night, because I might have given up some to the upside on the long VIX, but I got it off the table and got my risk back to a manageable level. So one more quick topic here, and this just has to do with a psychological thing. It's all in the trading plan, but I think that there are only four kinds of market days. There's trend up, there's trend down, there's inside, and then there's outside. I think that encompasses every single market day. If you're long the market and it's a trend up day, you're happy. If you're long the market and it's a trend down day, you get stopped out, but now you're on a short trend and maybe that's going to be profitable. If it's an inside day, you have time for reading and maybe going out and gardening because nothing's happening.
Nothing's happening.
But the outside day, and this happened, it was Trump Tariff Day, Monday, February 3rd. And I know for myself, it was one of the worst days that I've had because, and I have on the screen now, we're going to keep talking, but you'll see on the screen what it looks like, what an outside day looks like, several examples of them. If you're long, the outside day can start on the short side, stop you out, stop you in long, go all the way back up, stop you back out of that short, go long, stop you in again if it's a three-sided outside day. And they're rare, but it happened. Not in every market, Monday, February 3rd, but in many markets.
Yeah, it actually happens about 13% of the time, according to my studies.
Really?
And
13%. And outside day?
13%.
Wow.
So it's pretty common, but 13% is not the vast majority of your days. But that particular outside day, I'm just talking outside days in general, and some outside days are just, they don't even hurt you that badly because you're already in a position and it's just a little outside against you and then goes back in your favor, and by the end of the day you've made money. So, and you haven't reached your stop loss points or anything, even though it was an outside day. Depends on how tight your stops are. But
exactly,
lots of outside days where they don't mean anything. They just continue the profits. So it's only a fraction of that 13% that really, really hurt you. And boy, that Monday, that was one of my tough days. So they come along in trading. It's kind of part of the whole scheme. You have to ask yourself, how often are you going to see days like that? I would choose to prefer to think that, it's not going to happen very often. I can, it doesn't knock me out of the game. And, I'm having good days like today where I think I'm up 0.8% today.
Yeah.
That's a good day. You start, racking up a few 0.8% and you're coming out of the drawdown pretty fast.
So two questions then. Based on 50 years of back testing and everything, how often would you say we as traders can expect to see a February 3rd where you get nicked on both sides, and sometimes three times in one particular market that day? In the Canadian dollar, for me, I literally had in and out three times in an 8-hour period.
That's partially because of you probably having techniques or indicators that are tighter. The wider your indicators, the more likelihood that you might not have had three trades. You might have had at least one, maybe two, but the third one might not have occurred because your indicators wouldn't be that tight. But depending on your strategy, the answer to your question is it's a changing number, because if you ask me whether that could happen to the extent, say back in 1980, I would almost tell you probably not, because you don't have the speed. The market can't move fast enough during one trading day to trigger that kind of action very much. Even the 87 crash was one directional. It was, so you have an extreme volatility day, but it's in one direction.
Right.
So to have an extreme volatility day combined together with an outside day, combined together with your indicators coming into play in that outside day, you're talking a rare occurrence, 1% or less. But as computers become more prevalent and speed of markets increases, therefore, because you can just move lots more money, a lot quicker, and prices will react to that. I think you're going to see the potential for more things like that going forward than you would have seen, say, 50 years ago.
Certainly in 1980, program trading and arbitrage wasn't as sophisticated because the computers just couldn't do it. So that continues to exacerbate a day like February 3rd. So the last thing,
examine that. When I started back in trading futures, you had to call your broker on a telephone, a landline. They didn't have cell phones.
Yeah.
So I'm calling on a landline, putting in the order gets written up, put into a teletype office. The teletype puts it down to the floor. A runner takes it out to the pits. Pit gets handed a ticket. He then does his hand signals and executes the trade or whatever, and then fills out who he traded it with, throws it down on the floor. The runner picks it up, takes it back to the teletype back to the office. The office takes it off the teletype, walks it down to the broker's office, puts it in his inbox. And that all takes maybe a half an hour. In today's world, I do a trade on my left screen, which is my trading screen over here to my left, and the confirm comes lower right side on my main screen almost before I can turn my head.
Yeah, it's awesome.
Different world.
No question. No question. Something you didn't talk as much about, or else I missed it, in not the first book, but the second one, The All-Weather Trader. Do you ever, or would you recommend for, I would say, a beginning or even intermediate trader, if there's a day where you're just really on the wrong side of the market in multiple fields, is there ever a portfolio stop loss where you just cease trading for a certain period of time if you hit a certain dollar amount or percentage of equity?
I wouldn't do that just based on equity and just taking losses.
Okay.
But I would ask yourself, go into each of the markets and understand your indicators, because you should have already done that before you even started trading. And ask yourself, given the market action that market is going through, market by market, against the indicators you're using to trigger your buys and sells, has anything materially changed? Is there anything that's unusual? If you're taking losses, should you be taking losses given what your strategy is? And if you're taking losses and that's your strategy and you're still a fan of wanting to buy and sell using that type of a strategy, then it isn't broken. Don't fix it.
Agreed. I learned something from you a few days ago when we were let's try it again. When we were previewing this interview. I've been using Bollingers and Keltners in short time frames, 2 hours, 4 hours, and you mentioned to me, and I bet there's some people watching this that are doing that. Not a good idea. So that would be an examination that one might want to have on a day like that, where you've got, talk about back and forth, 2 hours and 4 hours. You think a daily outside bar is crazy on Feb 3rd. Imagine what 2 hour and 4 hour assets that we're trading on that time frame were. What are your thoughts on that for everybody to hear?
Yeah, I think when you get into moving averages, if you're doing a 200-day moving average, I don't care what kind of trend following model you use, you're going to get in within a day or two of every other indicator. And if you're trying to hold something for a year and a half, 2 years, it's not going to make much of a difference. You might be 1 day late, you might be 1 day early. It isn't going to make a difference if you're trying to pick up hundreds of percent on NVIDIA or something. Where things come into play a lot more is when you get into the extremely short time frames and you start getting into moving averages. There's going to be a tendency mathematically for the prices to go through that moving average up and down all over the place. And Keltners and Bollingers are both based on a moving average of some sort. I use exponential, but some people use simple moving averages. It's whatever floats your boat. But it's a moving average, and you're going to have a tendency on a very short-term time frame, even though the moving average would be very sensitive and try to keep up. It's by its very nature an average, and an average of a very short-term price is going to get the price moving up and down through that moving average quite a bit. And the same would be true of Keltners and Bollingers. You'll find yourself sort of almost trading the noise, and you'll get chopped a lot. So what I prefer to do there are things more like Donchins, where you're looking at the outside of the price ranges, high and low, and letting all the in-between and the small short-term price action to sort of float in between those extremes. I find it a lot easier and more logical. Because during the day, if you're trading 2 hours or 5-minute bars or 10-minute bars, I mean, you're talking a lot of data, so you're going to be in a lot of noise, and you got to give it enough room for the noise to sort itself out.
And of course, you got to have position sizing correct so that you're not taking too big a position, which may limit markets. I, for instance, would love to trade full size coffee, and full size even cocoa. Right now on a $500,000 trading account, really tough to do if you want to keep your risk down low enough. But this has been awesome. Last question. It wasn't in my script, but I'm going to ask it anyway. So Donald Trump has been in office for 4 weeks and a day. And Tom and I are about
how come he hasn't stopped inflation?
Yeah, exactly. Hasn't dropped inflation. I mean, but what we are seeing is definitely heightened volatility in the markets and unpredictability. If we have properly created our trading system with these indicators that we're using, might we want to expand the range of those just a little bit so we're taking fewer trades? Because certainly he has the ability to rock markets and create more noise, as you call it, than we might have had during, say, Biden or even Obama.
Well, you could argue that whoever is in this age of 24/7 communications and instantaneous everything, and then we're getting closer and closer to 24-hour trading, because you got CME and Globex and all those days have continued to make liquidity almost around the clock, with a few exceptions to, close down the computers and close the day and start the new day or whatever. And so I think over the long run, you have to kind of sit back, and as the markets change, due to news, due to the technology that continues, we got AI is going to be the next big thing, and you're going to have to try to assess what effects that having on the market and noise. And in the end, the trader's job is to separate noise from information. And no matter how the rest of the world is trading and how often or what time zone they're trading in, they're always going to be creating noise and information. And you're going to try to figure out the difference between those two. Yeah. So if you think there's going to be additional noise, or if you're measuring due to volatility measurements that there is in fact continually more noise, you could always say to yourself, all right, if my indicator is not noise oriented, then I might need to re-optimize or give it a little more space. But in the case of Keltners, Donchins, Bollingers, you have a component of volatility in there. And if you're going to get more noise and it's a repeated extra noise all the time, then those bands are always going to start separating and always be bigger. All it's going to do is force you to have more in your account to be able to handle the size of the position.
Exactly.
But the indicators sort of take care of themselves. If you're doing Donchins and you've got these wide swings, and the Donchins are just going to get farther apart, your risk per trade, per unit, like per contract or per share of stock, will get greater. But it doesn't change anything because the indicators already help you capture that larger noise.
Right.
and protect you from it to the extent that, math can do that. It's not perfect, but
Right.
we've taken a shot at giving the market a little bit more room to move. And
if the
that's why I
bands are
like
farther apart, we're going to be trading less size, which is not such a bad thing in a very volatile environment. So,
well, we have to all think. I mean, I realize, I always use the example of a $100,000 stock account. You have to realize that when I started as a chemical engineer in 1974, I was making $12,000 a year. $1 million back then is worth a lot more than is a lot more million in today's dollars.
no question.
So you have to kind of realize that. I mean, we had $1 million minimums at Trendstat, and I closed that down 20 years ago.
Yeah.
I've been retired. So the $1 million minimum account size from Trendstat to do what we did back at Trendstat days is now probably, who knows, 2 million, 2.5 million.
Yeah.
You have to kind of, the math is the math. Unfortunately, you can't change it. If you're trying to be protective and dial in your position sizes and do it in a religious and kind of systematic way, sometimes you just have to have a little bit bigger account size, trade smaller numbers of instruments. Just
both of
to
those.
get even minimum size of a position.
We are blessed to have micro contracts. Minis are great, but micros are awesome, and they're getting more and more liquid. It's astounding, really. So,
why is that? It's because people only do have a $100,000 account or whatever.
Exactly.
They're starting out. They don't have the multi-millions, so they have to have something they can trade that makes sense and get their feet wet and get used to buying and selling and all the problems of trading, and then graduate up to the bigger contracts as they can.
As they have
and I think
confidence,
that makes a lot of sense. I'm a big fan of what the CME's done on micro contracts, and I
no question.
try to promote them to new traders as much as I can, and I've mentioned them in a lot of places, and there's constantly new ones coming out. You have to almost subscribe to or keep checking out at CME.com.
And that's exactly what I do.
You just got to keep looking for new ones. And another thing about the micros that bears repeating here, because some of your users might be interested in that. You look at some of the volumes in these things, and they will be sometimes very, very sketchy, like very low volume. And it makes you think, wow, this isn't very liquid. If I moved 5 of these, I would have a problem. But truth be known, you're going to have market makers sitting there, and some of these are going to be computerized market makers, robots that are going to look at the big crude oil contract, and they're going to look at a micro crude oil contract, and they're going to say, wow, this is like 3 ticks apart, so I'm going to buy this one and sell that one. And what do? They force the prices together again.
Exactly.
So if you were to come in and try to do a trade, they'll take advantage of any mispricing that comes in. And therefore, if you're careful with what you do, it's really not that much of an issue. You will get pretty cheap pricing.
The arbitrage players used to be between New York gold and Chicago gold, or silver. U.S. bonds and silver, sure. But now it's between micros, minis, especially contracts like the S&P and the NASDAQ and even the Dow and the Russell that have 3 levels of contracts. So all that arbing really helps us. Guys, I hope that you have been encouraged by this. Tom always brings us so much wisdom that we can apply in our own trading. That has certainly benefited me, and I certainly hope it has benefited you. Watch Tom's channel. He's interviewed a lot, and each time he's got new market wisdom for you, and especially as we move forward in this interesting political culture in America, I think trading will get to be even more, I want to say, exciting. That doesn't mean we'll make more money, but it'll give us opportunities to use our trading plan, which we talked about today, refine that, and become better traders. Tom, thanks so much for sharing your wisdom with us, my friend.
It's always fun talking to you.
All righty. We'll do it again next time. So there you have it. I hope you enjoyed my talk with Tom Basso and got something out of it. Whether you're a seasoned trader or you're a retail client that just wants to understand the mindset and the psyche of a portfolio manager, I hope that you found this video useful. We'll be doing more of them. We hope you'll continue to come back to our site and see these special episodes of CB3 Live that are separate and different from my programs on every second Thursday of the month. Thanks for watching. If you have ideas on people you'd like me to interview, please send them to me, cb3@cb3.com, and we'll entertain those and try to get those kinds of interviews for you. Thanks for watching. We'll see you next time.